Welcome back to class. In this very lesson, we will be looking at financial analysis and decision making. And I want us to start with your assignment ratios from last class. What did you get for the current ratio? So just go through it, and you should have, for current ratio, it should be from the data. Our current ratio should be current ratio equals 84,500 divided by 42,735. So cross-check with yours. Cross-check it with yours. Let's see. That will give us 21.98. Eighty-four, 5, 42,735. Yeah, so approximately that's 1.98. So that's what you should have. Then for the net profit margin, this will be 51,765 divided by 480, which is going to be 10.8%. Then for the return on equity, ROE, what you should have is 51,765 divided by 101,765. So what you should have is 46.3%. This is what you should have. So if you got all this the same, that means you are correct. And you have started thinking like a financial analyst. So today we are going to interpret these ratios and also go into capital budgeting, which, like I said, capital budgeting has to do with how a business decides whether to make a major investment or not. So to begin with the ratios, the first ratio we'll be looking at is the ratio called financial ratio analysis. And we'll take some categories under it. So we have financial ratio analysis. Financial ratio analysis. So under this ratio analysis, we have category 1, liquidity ratios. Now, when you're going into being able to prepare financial models, you must understand this ratio and exactly what it means. Because when we talk about liquidity ratio, it tells us, can this business pay its short-term obligation? Or the business cannot pay its short-term obligation, or it can pay. That's exactly what it helps us to achieve. I hope you understand. Can the business pay its short-term obligation, or it cannot pay its short-term obligation? And this is where you have current ratio and quick ratio under it. So when we look at liquidity ratio, we have current ratio as a type. Now the formula for current ratio is current assets divided by current liabilities. And you know, these informations will be on your statement of financial position. So which you can see we got 1.98. Do you understand? So if you do this, you should get 1.98. So where you have 1.98, if we are to interpret this, we will say this is good because if you look at it, it is above. So let's do the interpretation. We say good because it is above 1.5. That's it is greater than 1.5, which is healthy. So the second ratio here we can talk about is the quick ratio, which is also called acid test ratio. For this one, it is given as current assets minus inventory divided by our current liabilities. So if you do these two from that data set, you will see that we'll have 1 as our 1.0 as our quick ratio, acid test ratio. So what this simply means is that if we are to interpret this, we have to watch inventory. So now the current ratio of 1.98 here, this ratio here of 1.98 means that for every 1 naira of short-term debt, the organization called Lego Smart has 1.98 naira of current assets to cover it. And like I said, that is healthy. But the quick ratio of exactly 1.0 here. Once we remove inventory, means their liquidity depends a lot on selling that inventory. If sales slow down, they could be in trouble. And that's why I said they need to watch on inventory because that's actually the borderline. Now, let's go to category 2. Okay, so for category 2, we'll be looking at profitability ratios, which is also important as far as financial modeling is concerned. Profitability ratios. Now, for profitability ratios, these are ratios that measure how efficiently the business converts revenue into profit. And you know what revenue are. So converting revenue into profit is what profitability ratio is majorly concerned about. So under profitability ratios, we have gross profit margin. And our gross profit margin is given as 144,000 divided by 480,000, which will give us 30%. And this is reasonable for a supermarket. Then here we also have another ratio called net profit margin. Our net profit margin is 51,765. divided by 480. This 480, hope you know, is the revenue. So look at the data set. That's where I'm taking the figures from. So when you divide this, you get 10.8%. This is also very strong for retail business based on the scenario we are looking at. Then the next under profitability ratio is the return on equity, the one I gave as assignment, which is also called ROE. So for this one, this gives us 51,765 divided by 111,765, which is equal to 46.3%. And this is also excellent for shareholders because shareholders are getting good returns at the end of the day. Then we have return on assets, which is ROA. So this is 51,765 divided by 174,500, which is giving us 29.7%. This tells us that the assets are being used productively. The next category of ratios you must know as a financial modeler is efficiency ratios. Now, for efficiency ratios, there are ratios that tells you how well the business manages its assets. So these are things that you expected in your financial model. You can have a particular tab called ratio analysis. At the end of the day, you build it also. It gives you more, makes you to show that yes, you know what you're doing. So efficiency ratios tells us how well the business manages its assets. So if we want to know how well a business like Lego Smart manages its assets, we will then run an analysis on inventory days for them. Okay, we'll look at inventory days. We'll look at debtor days. Inventory days, we'll be looking at the number of days it takes the company to sell their stock, okay, through its stock. Then debtor days, you'll be looking at the number of days it takes them to collect from credit customers within 14 days, within 30 days, and all of that, whatever the result is. They also have creditor days, the number of days it takes the company to pay their supplier. Okay, so all these things are also what we call cash conversion cycle. Cash conversion cycle, because at the end of the day, that's what you're looking at. You want to know what's the cash conversion cycle. You now need to add up inventory days plus debtor days minus creditor days. In accounting, in business, we have what we call working capital. And it's very important because if a business should have an efficient working capital, then the number of their conversion cycle matters a lot. Because if a business, let's say the cash conversion cycle is 28.4 days, that means that such business needs 28 days of working capital to fund its operations. Therefore, they need to keep it funded at all times. So these are very important, very, very important. Then category 4 are the ratios we call leverage ratio. So you can also go and study on these ones, leverage ratios. Now, leverage ratios are ratios like your debt to equity, your interest coverage, very important. So these are important and you need to go look at them. Then lastly, we have not actually a category, but an important aspect called capital budgeting, which I mentioned in the last class. And I cited NPV, and I also cited IRR, internal rate of return. So let us say this organization called Lego Smart is considering opening a third branch in Surulere. And the owner, Chidi, needs to know, is this investment worth it? This is where capital budgeting comes in. And the two most important tools are NPV and IRR. So what NPV stands for is net present value, like I said before. And it asks a simple question. If I invest money today, what is the present value of all future cash returns from that investment? And does it exceed my initial investment? So the logic is that money today is worth more than money tomorrow. 1 million naira today can be invested and grow. So what we do here, as in our financial model, we discount future cash flows back to today's value, especially when we are looking at the capital budgeting aspects. We discount future cash flows back to today's value. And there is a formula for this. There's a formula for this. The formula is NPV equals initial investment plus cash flows divided by bracket open 1 plus arrow bracket close raised to power. This will be raised to power 1. This one is raised to power 1. Raised to power 1. Plus cash flow 2 divided by 1 plus arrow raised to power 2 plus and so on. Okay. Now, if there's anything you need to note here, this arrow, where arrow is equal to discount rate. Which is the same thing as the cost of capital. Can you see it? So if Lego Smarts, the new branch, let's say the initial investment in the new branch is 25 million. And we are told that the expected net cash flows, let's say for 5 years, can be let's say 8 million for year 1, 9 million for year 2, 10 million for year 3, 10 million again for year 4, and 8 million for year 5. Then we are given that the discount rates, let's say we are told also that the discount rate is 18%, which is 18%, their weighted cost of capital given Nigerian interest rates. So if we want to arrive and find out our net present value, what we will do, we are going to calculate this together. Okay, don't worry, we'll calculate this together in our next lesson. The next lesson where we'll be looking at building a three-statement financial model. I think that's the last lesson. So in that last lesson on building a three-statement financial model in Excel, because in that lesson, I'm going to teach you how to build a fully linked three-statement financial model. including 5-year projections, ratio analysis dashboard, and then this NPV and IRR analysis. So there are key assumptions we'll also be looking at. I think that class, that one is very important session. So, but what I'm trying to say is this. This now, with this, you can apply it to this formula. Because you have the discount rates, right? And you have the cash flows for the first year, second year. So that's why I said can continues. Don't forget these two, we will raise for 2. This one will be raised for 1. The next one raised for 3, just like that. So the next under tool under capital budgeting that we have is internal rate of return. So say internal rate of return, which is also known as IRR. Now, IRR, internal rate of return, is the discount rate at which the net present value becomes 0. I'll take it again. The internal rate of return is the discount rate at which net present value becomes 0. In other words, it is the rate of return the investment is expected to generate. In other words, it is the rate of return the investment is expected to generate. And there's a decision rule here. If internal rate of return is greater than the cost of capital, we accept the investment. But if internal rate of return is less than, we reject. So for Lego Smart, if the internal rate of return on the Surulere branch, let's say is 28%, and we are told that their cost of capital which is their cost of capital is 18%. So can you see that the investment adds value? So what do? We have to accept it because the internal rate of return, remember what we said. We said the IRR, the internal rate of return, is what? 28%, meaning is greater, right? It's greater than the cost of capital, so accept it. So a recap of today's lesson on financial analysis and decision making. Today we went deep into financial analysis based on what we did on the previous lesson 2. So you can now calculate and interpret liquidity, ratios, profitability, efficiency, and leverage ratios. And you understand the NPV and the internal rate of return framework for investment decisions. So in our final lesson, we are putting all this together in Microsoft Excel, where we are going to build a complete 3-statement financial model for Lego Smart from scratch. And that class is going to be the most practical session. So I want you to make sure you open your laptop and you get ready for it. See you in the next lesson. We build everything live. Income statement, statement of financial position, and a 5-year financial projection. Thank you.